Hello and welcome everyone to this month's market update for February 2025. My name is Steve Latham and I am the Chief Investment Officer for Bernicke Wealth Management. And today we're going to be talking about the link between tariffs and inflation. First, just to lay the baseline, we do believe tariffs, at least under the present administration, are being used as more of a negotiating tool than are intended to be implemented over a long period of time. Certainly the implications of those tariffs, if they were to be implemented over a long period of time, would be quite a bit different than the implications of them being used temporarily as a negotiating tool. We're going to be under the assumption of that they are a negotiating tool at this point, at least as it relates to how tariffs could impact inflation today. What we want to go through in today's presentation is how are tariffs actually implemented so that we kind of have an idea of what is going on at the baseline from a consumption standpoint and a business standpoint, and then go into how that could impact inflation over a longer period of time. Now, if we look at this infographic in front of us, what we see is a standard route of trade from a foreign country. If we have today a Mexican company that creates a product, it's called a widget, for $100, and the United States wants to purchase that widget for $100, the Mexican company is going to earn that $100, the US company is going to pay that $100, and then ignoring any profitability metrics just for simplicity, if that company goes and turns and sells that widget for $100 to the consumer is out that $100, they own the widget, the company recoups that $100, they are net neutral on that overall transaction. That's how trade is done at a very high level without any obstructions from tariffs or any other regulatory entities. Now let's add a tariff to the equation to see how that actually works. That Mexican company is still going to sell that widget for $100 to the United States company. But if we introduce a 25% tariff, that United States company is the collector of that tariff. The Mexican company actually doesn't pay the tariff. It's the company that is importing that widget into the United States. So that US company pays the $100 for the widget. They pay $25, or said differently, they actually collect $25 for the tariff. And that $25 is ultimately collected from the United States consumer or the end user and purchaser of that product. That tariff cost is passed along because the company isn't going to absorb that cost. They're going to pass that along to the next user in that supply chain, and often that results in a higher cost of goods because the consumer is paying that tariff in order to recoup that $25 absorbed by the company. Now, where does that $25 go? Well, the company doesn't own it. They have to pay that to the government. So that $25 goes straight to the government in the form of a tariff tax, or however you want to describe it. The United States consumer is still spending $125 on that widget, and the company has their $100 in order to pay for the base product, the base widget, and that is how the supply chain works whenever we're introducing a tariff. Now, as we can see, if widget prices go up because there's a tariff, technically that's inflation. It's inflationary to the tune of whatever the percentage is of the tariff. Now, that is only in that one product. If the consumer is stretched, which in today's environment they're not, but they certainly don't have as much money as what they used to just a couple of years ago, instead of paying $25 or $125 to buy dinner and goods and services elsewhere, they may have to only buy that dinner because the product is higher, and they're not able to spend on goods and services elsewhere because they're putting more money into the product that has a higher cost. Now, that just means that inflation is centralized to the products that are tariffed. If you have a broad sweeping tariff, then yes, that could be inflationary over the course of the entire economy. Again, right now, we're working under the assumption that tariffs are temporary, so we don't believe inflationary pressures are going to be a result of tariffs. However, if we are looking more broadly at what inflationary pressures are being derived from, we have to look at how much money is going through the economy. And the one way to view that is through something called the money supply. The chart that we have here in front of us is a depiction of how much money is in consumers' pockets. It's technically termed M2. And what this shows you is how much money is being lent from banks and being used from the consumption standpoint to go buy goods and services, to go build homes, to go add on to home renovations, so on and so forth. And we can see right during the COVID years, the money supply spiked. That was due to all the stimulus that was coming through from the federal government and from the monetary policy, allowing for the easy flow of money. Now in the orange line, overlaying the M2 money supply, we have the Consumer Price Index, or CPI, a very common measure of inflation. Inflation lags an increase in money supply, so we saw shortly thereafter inflation spike all the way up to that almost 9% level towards the beginning of 2022. Of course, inflation has come back down since then, but our current concern is not so much tariffs from an inflationary standpoint, it's this re-acceleration of the money supply. We've seen money supply continue to increase because banks are still flush with cash, consumers are still in a good, relatively healthy space, they're lending more, and so therefore there's more money coming into the market that's potentially causing inflationary pressures more broadly. Now, we haven't seen that in the inflation measure of CPI yet. However, as of today's recording, we did see the January CPI, and that did tick up a little bit hotter than what we expected. But that's just one data point, and we're not going to hang our hat on one data point. We need to see a broader trend, and what is more concerning from our standpoint, again, not tariffs, but an increase in the money supply that could potentially cause a reacceleration of inflation. That's what we're going to be looking for from an inflation standpoint. Of course, there's a number of other factors at play that we'll be keeping an eye on as well. But certainly it's a very dynamic environment, and we're going to be keeping our ear to the ground to make sure that we are kept abreast of everything that we believe is important, not only from an inflation standpoint, but from an overall market standpoint. If you do have any questions about anything we reviewed today or anything else that's on your mind, please feel free to reach out. We'd be happy to answer any questions for you. Thank you.